Hello, everyone. This is the concept of admission of a partner in the course Financial Accounting. I'm Dr. T. Ramya, Assistant Professor of Commerce, Sri Sharda College for Women, Autonomous, Salem 16. Actually, partnership is a firm which is constituted with more than two persons, and the maximum number of persons is usually 50. But in the initial stage, the partnership firm can be constituted with two or more persons, 2 to 3 persons. And in the later period, if there is any requirement in the side of partnership, in the course of expansion of the business, there would be an additional requirement of a new partner into the firm. So, in that case, with the agreement of the old partners or the existing partners, a new partner will be admitted into the firm, and the existing partners will agree to share their profits to the new partner for the capital brought in by the new partner. The new partner may also bring some value of goodwill, the amount of goodwill in the new partnership constitution that has been adjusted or by being identified by the existing partners in the computation of old value of goodwill that is existing in the business. So there are certain adjustments to be made with regard to the admission of a partner. The first thing is new profit sharing ratio, which is the new ratio after the inclusion of the old partners is to be identified. So in that case, when the new profit sharing ratio is computed, the sacrificing ratio of the old partners is also to be computed. And there is a need for the adjustment of goodwill. Goodwill is the new partner in the new partnership firm will be inclusive of the new partner, but what is existing in the business already will be shared by the old partners before admitting the new partner. So adjustment of goodwill is to be made in regard to the admission of a new partner. And sometimes the assets value and the liabilities value may increase or decrease, in which case the revaluation of assets and liabilities have to be done. And there is a requirement for the adjustment of reserves, in which case the existing accumulated profit and loss and reserves have to be distributed among the partners, that is old partners in the old ratio before the admission of a new partner. And there is also sometimes requirement for adjustment of the capital, including the new partners capital. So these adjustments have to be done before admission of a new partner into the firm. Let us see the process or the procedure for admission with regard to these adjustments to be made in the firm. The first one is new profit sharing ratio. In this case, the new ratio can be identified in two methods. One thing is the sacrifice of the old partners will be directly given. The other cases, the sacrifice will not be given. So in the first case, when the sacrifice is not given, there are two partners initially in a firm. Let us take us this example. There are two partners with the ratio of profit sharing ratio of 3:2, and they admit the new partner C into the firm for one of the share. Here, the sacrifice of the old partners A and B is not given, but the new partner share is taken as 1/5. So new partner share is one. If the new partner share is 1/5, the remaining partner share will be 4/5. That is taking 1/5 to the new partner and giving it to the new partner. The remaining partner will have a share of 4/5, which the old partners will share among themselves in the old ratio. So the old ratio is 3/5, and the for the first partner A, and 2/5 for the second partner B. So this remaining share, after giving it to the new partner, the remaining share is shared by the existing partners in the old ratio, which will be 12/25 and 8/25 after the share taken by the old partners in the old ratio. So the new ratio here will be 12:8:5. C share is 1/5. When the denominator is to be commonly made, when it is to be converted into 25. So 1/5 into 5/5, that will also become 5/25. So the new ratio is 12:8:5. There's another concept in the calculation of new profit sharing ratio, where the new ratio is given and there is also old ratio of the old partners existing in the firm. P and Q are partners in the ratio of 4 is to 2. That is, their sharing ratio is 4 is to 2. New partner S is admitted and the new ratio is 5 is to 3 is to 2. So in this case, the old share profit sharing ratio of the old partners is given and the new profit sharing ratio of the new partner is also given. New partners is also given. So here we are being asked to compute the sacrificing ratio. So there is no necessity of computing new ratio here, but we need to find the sacrificing ratio. So we also have to note this point like sacrificing ratio is equal to that is always old ratio minus new ratio because old ratio will be higher because the existing partners, if there are two partners, there is only two share made between the old partners in the old ratio. But when new partner is being admitted into the firm, there is a third party entering into the firm and there is a distribution of profit in the ratio of that is new ratio. The total profit is distributed among three partners. So there will be a reduction in the profit sharing ratio of the existing partners. So what sacrifice they make, that is identified by subtracting older ratio from the new ratio. I mean, new ratio from the older ratio. The old ratio will always be higher in this case. So here's P sacrificing ratio is, old ratio is 4 by 6. 4 by 6 minus new ratio is 5 by 10. So 4 by 6 minus 5 by 10, that will be the sacrificing ratio of P. Similarly, sacrificing ratio of Q will be 2 by 6 minus 3 by 10, that is 2 by 60. And the sacrificing ratio here is 10 is to 2 or 5 is to 1. So this is the new profit sharing ratio. So with regard to the sacrificing ratio and new profit sharing ratio, when it has been identified, the further profits of the firm will be distributed in the new profit sharing ratio in the forthcoming years. And similarly, this sacrificing ratio is identified to take up any benefit that is derived from the business in the past years that is accumulated, that will be shared by the old partners in the sacrificing ratio. The goodwill will be taken up by the old partners in the sacrificing ratios. And here there is a need for the adjustment of goodwill. Goodwill is the name of the business. It is the firm is earning some better business and it has got some good name in the market. So that a good name is given some value that is called goodwill. So there are three usual methods that are used to compile the or compute the goodwill. So first method is average profit method. Here, the total profit of all the years, if 5 years profit is given, the total of those profits divided by the number of years 5. So that will give you the average profit. And goodwill is average profit into number of years of purchase. This is a general calculation and easiest calculation with regard to the goodwill adjustment. And the next computation can be made with super profit method, where the super profit is to be identified, which is an abnormal profit earned by the firm. That is, you can identify it by subtracting the normal profit from the average profit. Average profit is what is actually expected from the business, and normal profit is what the business can earn. So average profit minus normal profit will give a super profit, and this super profit into number of years of purchase will give us the goodwill. So this is the other way. Here normal profit is usually computed with the capital employed in the business into normal rate of return. So super profit is some abnormal profit when that is identified by when calculating the difference of average profit and normal profit. So that goodwill into number of years of purchase will, super profit into number of years of purchase will give us the goodwill. The next one is capitalization method, where the capitalized profit is deducted from the normal rate of return. So capitalized profit is equal to profit divided by normal rate of return into 100. That is, we are capitalizing profit. We are bringing the profit to the full extent so we can identify the capital. So here goodwill is equal to capitalized profit minus total net tangible asset. So whatever is existing as asset in business, with that asset you can take out the total value, that is capitalized value of the profit, So something will be this existing in the business above the net tangible asset, that is identified as the goodwill of the firm. That is called capitalizing method. Here, the profit is capitalized, and this capitalized profit, that's capitalized value, is used as the base to identify the goodwill, hidden goodwill in the business. And from the capitalized profit, if we are able to deduct the net tangible asset, we'll arrive at the goodwill in the firm. And the next one is revaluation of assets and liabilities. See, whenever there is any change in the firm, composition of the firm, or in the structure of the firm, or in the functioning of the firm, the partners will try to estimate the value of assets and liabilities existing in the business. So in that case, it is called revaluation of assets and liabilities, which can be done even at the admission of time of the partner, or even at the retirement of the partner. So in the case of admission of the partner, if the value of the assets are increasing, the assets have to be debited and the revaluation account has to be credited. So here we are opening up a new account called revaluation account, where we'll post into all the changes in the value of assets. Either there may be an increase in the value of asset, or the assets value may decrease. Similarly, liabilities may increase or liabilities may decrease. So any adjustment with regard to the value of assets and liabilities have to be taken into the revaluation account. So that revaluation account will help us to come out with a profit or loss. So when there is an increase in the value of assets, it has to be debited and revaluation account has to be credited. When there is a decrease in the value of asset, the asset has to be credited and revaluation account has to be debited. There is this can be repeated for, taken into consideration for liabilities also. When there is an increase in the value of the liabilities, they have to be credited, because all liabilities will have a credit balance. This increase of liabilities have also to be credited. So in that case, the entry will be revaluation account data to liabilities account. When there is a decrease in the value of liabilities, the liabilities have to be debited. So liabilities account data to revaluation account. So after passing out all these entries, all the assets, if there is a change in the value of that, they will be transferred to revaluation account. So from that revaluation account, the profit or loss is to be identified by opening up the revaluation account. There is a profit in the revaluation account, that will be transferred to the old partner's capital account. So the entry will be revaluation account data to old partner's capital account. When there is a loss, that is also transferred to partner's capital account. The old partner's capital account to revaluation account will be the journal entry that is to be passed. The next one is adjustment of reserves and other accumulated profit and loss account. So this tells us that whenever there is a change in the composition of the old partners, before admitting a new partner, whatever that has been enjoyed, or whatever that has been accumulated by the old partners in the business in the form of general reserve or profit and loss account, will be shared by the old partners in the old ratio, because it is their own profit. And whatever that is kept in the business, not taken up they're not taken up by the partners in the course of the business, that will be shared by them in their old ratio before admitting a new partner. So this will be the general entry. A general reserve account data, profit and loss account data to old partner's capital account, where we have a general reserve and profit and loss account. These two reserves will usually have a credit balance, and when we want to close them by transferring to the partner's capital account, we have to debit them. So the entry is general reserve account data, profit and loss account data to old partner's capital account. Similarly, if there is a loss, accumulated loss in the account of the partners, those losses have to be borne by the partners. So in that case, the partners capital account have to be debited, and the accumulated loss, any kind of loss that is in the business before admission of a partner, that loss will be borne by the old partners. So that will be transferred to the old partners capital account, and the entry will be old partners capital account data to profit and loss account. And the next one is adjustment for capital. So here there is a computation of new partner's capital account. That is what is to be brought in by the new partner. That will be one adjustment, or based on the new partner's capital brought in by him, the old partner's capital will be adjusted. So two cases may happen. That is based on the new partner's share of capital, what is brought in by him, the old partner's capital can be adjusted. Or the old partner's capital composition can be computed, and out of that, total composition, the new partner's share can be identified and that will be brought in by the new partner. So the worst case is based on the new partner's capital account. So if a particular partner is bringing in capital, so his share of capital is for his share of profit, the capital is taken into consideration and the total capital of the firm, what should be the capital of the firm is identified and that will be shared by the remaining partners. Say for example, if one partner is bringing in a capital of 50,000 for 1/4 share, so total capital of the firm will be 50,000 into 4. For 1/4 share, if the capital is 50,000, total share is 4 parts. Okay, 1/4 is the new partner share. The total share of the company is 4. 1/4 indicates that 1 is the new partner share, 4 is the total share. So total share is 4 into the capital of the new partner is 50,000. So 4 into 50,000, 2 lakh is the capital of the firm. So this total capital, by taking out the new partner share 50,000, we'll get the remaining partner share as 1,50,000. That will be brought in by the old partners in their new ratio. So this is the computation of the or adjustment of the capital account of the partner based on the new partner's capital account. Similarly, new partner's capital will be computed based on the old partner's capital account. So, for example, the old partners let their total capital be 75,000 totally, not including the new partner's share. The old partner's share is 75,000 for 3/4 share. So if for 3/4 share, the old partners is holding a share capital of 75,000, the total capital of the firm is identified. So for 75,000, if the share is 3/4, let us find out for 4/3. That its total is 4. So into 4 divided by 3, that will be 1 lakh. So total capital of the firm should be 1 lakh, which should be divided by all the partners, others, including the new partner in the new ratio. And that is to be brought in by the new partner, and also the existing partners if their capital is to be adjusted, like if they are holding 50,000 and the new capital is 60,000, they have to bring in 10,000. Or if they are holding 60,000 as capital and the new share, if their new share is only 50,000, that will be written back to the partner. So this is the adjustment to be made with regard to the capital. So these are the procedures to be undertaken in case of admission of a partner. So when all these adjustments are done, the partnership firm can be made into a new constitution with the admission of a partner. So without these changes, the partnership firm cannot admit a new partner. Thank you.